Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency market this week and in the week ahead. This week, I'm joined by Brian Daingerfield, who is our US head of G10 FX strategy. And Brian, I really wanted to start with the Fed this week. They obviously released their rate decision, but also updated economic projections and the dot plot. But this was the first time they'd done so actually since Trump came to power, and they're doing so amid really elevated market concerns over a slowdown in US growth. What were your key kind of takeaways from these updated projections from the Fed?
Yeah, thanks very much, Eimear. So this was a really interesting Fed meeting because, as you mentioned, this was an opportunity, really almost a requirement for the Federal Reserve to put some numbers on paper as to their assumptions about growth and inflation in sort of the Trump 2.0 era. So as you mentioned, the last time we got updated forecasts from the Fed was in December. And what they told us in December was their growth and inflation forecast, but also their dot plot, which is their projection, the median projection of where members see the federal funds rate at the end of the next couple of years. Now, what the market was looking forward to was, are there going to be any changes in this projection? Because over the last couple of weeks, we have seen markets' assessment of recession risk here in the US has risen. But also at the same time, markets are worried about the potential for higher inflation coming from tariffs. And if you're the Federal Reserve with a inflation mandate, but also a growth mandate, an unemployment mandate, how do you balance those risks? And what does that mean for the signal the Fed is sending about the policy rate? The Fed, I think coming into this, most expected the Fed was going to stay firmly in a wait and see mode. And that is indeed what they did. But I think the market really responded to a couple different stimulus from the Fed's projections and how they talked about the outlook. And so from the projections in particular, growth forecasts for GDP growth for 2025 was revised down, so a weaker assessment of GDP growth. But their assessment for core inflation in 2025 was revised higher. And so this view of, their goals becoming almost increasingly in conflict. Lower growth would suggest maybe a need to be more aggressive in terms of returning to interest rate cuts at some point. But higher inflation kind of pushes in the other direction. And so what the Fed did with its dot plot, the projection for the policy rate, was they left the profile almost completely unchanged. So the Federal Reserve continues to project just 2 interest rate cuts, 50 basis points of reductions in 2025. Now, in December, when the market was pretty confident that the Fed was maybe going to be on hold for longer, growth expectations were higher. That was arguably a somewhat dovish development that the Fed is still looking at interest rate cuts. Now in March, market expectations for the Fed have changed pretty meaningfully, and we came into this meeting thinking the Fed could cut even more than they're currently projecting. The markets are pricing 75 basis points roughly of interest rate cuts this year. But what the Fed effectively said, and Powell echoed this at the press conference, was the dot plot right now doesn't just reflect the expectations of the Fed. It also accounts for a lot of uncertainty on policy coming from both the fiscal side and how that might feed into the economy. And I think if the Fed had their way, they might have actually preferred to not release a dot plot at this meeting. That almost feels like what they tried to do, which was to say, we are so uncertain about what fiscal policy will do and how that will impact the outlook, that we almost went out of our way to try not to make major changes to their assessment of growth and inflation and what it means for the policy rate. So when we look at all of this together, there's almost a stagflationary feel to what the Fed announced in terms of their forecast, right? Lower growth, but higher inflation, and not a lot of additional easing. In fact, no additional easing in their projection to account for these changes. But when Powell was asked about inflation risks from tariffs, a lot of the questions were essentially, do you see yourself as restricted, limited in your ability to ease because of tariff-linked inflation? And Powell gave kind of mixed answers, but he did say something that was very notable, which was the possibility that inflation linked to tariffs is transitory. Now, transitory is a word that's gotten a lot of criticism in the post-pandemic era. But what Powell effectively said was that there's some amounts of inflation that the Fed might need to effectively look through because they maybe cannot control it. And it's something that not necessarily would be permanent because a one-time tariff increase will eventually roll out of an inflation calculation, say a year-over-year number, a year down the road, for example. And so I think the market heard one thing it really wanted to hear, which was that the Fed may not feel that it's extremely restrained by higher inflation if it turns out that growth slows enough to force them into potentially easing interest rates. So the dollar has been quite choppy through all of this. It actually sold off pretty sharply in the aftermath of the decision as Powell was speaking on Wednesday afternoon here in the US. This morning, as we record on Thursday midday, the dollar's actually bounced back for quite a bit of that. And I think that in part reflects the difficulty the markets are having in trying to internalize this message, because the markets are seeing a growth outlook that makes the Fed maybe more likely to ease more aggressively this year. They're also trying to weigh the inflation risks. What Powell effectively told us is that there might be a path for the Fed to return to interest rate cuts, even if inflation is high. That's something the market, I think, interpreted as dovish. But the reality is they didn't actually change their projections for the Fed fund. And so they weren't trying to signal to the market that that's their baseline. They seem pretty firmly in wait and see mode. And our own concern is that this wait and see mode, this waiting for clarity the Fed has been telling us they want to do, that could extend for quite a while here. It's wholly possible that we're at the June meeting and the Federal Reserve is still waiting for clarity on fiscal policy changes. Because as you know, Eimear, especially when it comes to trade policy and some of the changes on the federal level here in the U.S., these policies appear to be in flux and changing really daily. So we're not so certain that the Fed's going to have that confidence to maybe move off the sidelines until later, maybe not at all this year. But the main takeaway from the Fed is it seems like they're pretty firmly in wait and see mode now.
Yeah, I guess really waiting for their cue, I guess, from Trump. But I know you kind of made a point before about, yes, we've seen kind of growth data come off in the US, but made that distinction between, the hard data and the soft data. How do you think that actually impacted the Fed's decision yesterday?
Yeah, that was a really important one because most of the slowdown we have seen here in the US in data has come from what we call soft data. So things like consumer confidence and survey data and data that are telling us what people think about the economy rather than what they're necessarily doing. And so that's what we like to call hard data, which is employment statistics, job gains or losses, retail sales, how much people are actually spending. So a nice way to think about this differential is if people tell us they're spending less, but it turns out retail sales are actually going through just fine, then maybe there's a disconnect between what consumers and businesses are telling us they think the risks to the outlook are and the actual strength of the economy. Now, this would not be the first time in the post-pandemic era that soft data were telling us that markets, consumers, businesses' expectations for the economy are increasingly to the downside, but the actual economy holds in. That's really been one of the big sources of upside surprise in the US economy. This resilience has been, the hard data have been quite firm, despite the fact that confidence has come down. A big part of that, if we sort of look back to the really high inflation days in the immediate aftermath of the pandemic, I think 2022, with higher oil prices thanks to Russia's invasion of Ukraine, for example, there were reductions in consumer confidence related to inflation, but it didn't really have meaningful impacts on actual spending. And the employment market remained very strong, and that actually helped the economy weather through a period of lower confidence. Now I think the Fed is trying to deal with a similar challenge, with the challenge coming from consumers and businesses are telling us that they are more uncertain, and that might lead to lower economic outcomes because of, among other things, the rapid changes in fiscal policy, the rapid changes in the employment situation for federal workers, and also from tariffs and the uncertainty around what's going to come in, what's going to be implemented, what's delayed, etc. But the hard data have not yet slowed. And to be fair, we really only have 1 month of hard data to go off of. And the retail sales number we got earlier this week was actually pretty solid. We did see a bounce back in core sales. Now, you can add in there that weather-related disruptions to data in January may have artificially depressed a lot of the data in January. What we're seeing in February data so far that's been released throughout the month of March is that these data are coming in stronger than expected in some cases. But the Fed is really trying to find that right balance of acknowledging that soft data are telling us the risks to the outlook are higher, but also understanding that soft data have given us false starts in terms of slower economic growth before, and maybe not trying to put too much emphasis on the soft data. It's really about that translation. And so I think the Fed and the markets are really trying to find that right balance. And I think what we've seen the dollar has consolidated here a little bit. I mean, in terms of it had sold off pretty meaningfully in the earliest parts of this month. More recently, it's consolidated, if anything, strengthened a little bit against the majors. That might reflect some of the hard data we've seen, not necessarily pushing the market's expectations for a recession further, which I think has been the big driver of the dollar here. And so as we get into early April, when some of the big data starts to come through, we're going to see both hard and soft data to digest. Think about the ISM services and manufacturing data. That's more soft data. That's what businesses are telling us. But if we don't see that weakness coming through in the actual numbers, that might make it even more difficult for the Fed to get a sense of where the true trend of the economy is at the moment.
Yeah, I guess yet another reason for the Fed to be on hold and kind of wait and see mode. We did have another central bank recently, which is the Bank of Japan, that decided to keep interest rates on hold. What were your big takeaways from the decision, and how do you think it impacts the outlook for the yen?
So the BOJ delivered what was almost universally expected as an unchanged decision on its interest rate, no hike in the policy rate. But we don't think that means that normalization or further interest rate hike is off the table for the next meeting in May. But the Bank of Japan is facing a lot of uncertainty in the immediate future, and we felt it was appropriate for them maybe not to tip their hand either way in terms of what they will do as soon as their next meeting in May, which is when they will release their latest outlook report. That includes updated forecasts on growth and inflation in particular, which is a really big focus, of course, as the Bank of Japan is really tying their normalization to achievement of its underlying inflation scenario. Right now, we're in the middle of shunto wage rounds when many large and small labor unions are negotiating with businesses. This is a very important time of the year in terms of wage increases. What the BOJ has been telling us is that they think that because of persistent labor shortages, that wage pressures are likely to be even stronger this year than they were last year, which was already a record-setting year. The early preliminary evidence we have suggests that that's probably coming through. But the Bank of Japan actually hiked their policy rate in January. One of the reasons they cited was that the anecdotal evidence they were getting on wage growth was actually really positive. They were hearing from their contacts that these wage rounds were probably going to be on the high side of expectations, and that gave them the confidence to move ahead with a rate hike in January rather than waiting for more evidence that they would have had at the March meeting. So when I think about the March meeting, I think that the Bank of Japan delivered the rate hike that would have been done today at their January meeting, and that bought them time to be patient on what's happening with all these uncertainties. As we look ahead, the big one to watch in terms of potential downside risks is what we may or may not get on April 2nd, the big tariff announcement here in the U.S., the day of tariff liberation, as as the President Trump here likes to deem it. It's unclear. There's so much uncertain about what will or will not be in that announcement, and how much specifically Japan could be facing additional tariff increases. Is there an ability for Japan to negotiate its way out of tariff increases? They've had some success in the past, certainly during Trump 1.0 under former Prime Minister Abe, and the President Trump had a very good personal relationship, and I think that helped Japan maybe avoid some of the worst in terms of tariff escalation. It remains to be seen, but that has been a big risk that they flagged. We will see what we get on April 2nd, but we're also going to be looking ahead to the Tonkan survey in early April. That's a really big one because it gives businesses an opportunity to tell the BOJ what they're seeing on wage inflation, what they're seeing on labor shortages. If they get more good news, that could keep the door open for a move in May. So the Bank of Japan really didn't move the needle all that much. I think that's understandable given they already hiked in January, and they're looking ahead to these big potential uncertainties. But we don't think that necessarily closed the door on a move as soon as the May meeting. But we just have to get through a lot of different roadblocks, specific risk events in early April before the BOJ is probably going to be able to give the market some clarity one way or the other.
And I guess on that very point, I cannot let you go without asking about the outlook for US tariffs. I feel like all global economies are just on tenterhooks waiting for April 2nd to see if there is a big escalation in US tariffs. What is the latest? And I guess how does it inform your view on the dollar?
So one of the things we've been hearing over the last week is it appears that from commentary from advisors and also from reports in the media, that it looks like the administration is viewing reciprocal tariffs in a one country, one number sort of format. Essentially, they're going to take the totality of tariff regime for imported goods from the U.S., in addition to any non-tariff barriers, and set effectively a magic number, which is that your goods from that country will go up by a certain percentage point to reflect all of these different changes. And that number is going to be, I don't know if it'll be all goods, but consistent across goods from one country, but the numbers will differ country by country or country by block, if you think about the EU, for example. So Japan's number could be one level of increase. The EU's could be different. Across emerging markets could be very different as well. But it doesn't look like they're going to go line by line, good by good with each country, and instead take a more holistic approach. Now, in terms of trying to estimate where that number could be, what is that magic number? There's a lot of difficulty here in the non-tariff barriers. That creates a lot of uncertainty because you can look at, if you go on, say, WTO or the United Nations or through World Bank data, even from the USTR themselves, you can look at most favored nation tariff schedules between the US and its peers and make an assessment about average tariff level differentials and see how that impacts the potential for tariffs to go up. So I'll use Japan as an example again, because we were just talking about them in this context, that the weighted average tariff for most favored nation for the US is about 2.2%. For Japan, it's actually a bit lower than that at 1.7%. So in that case, if you're thinking about just tariffs, it seems unlikely that you would see an increase in tariffs at all if you were just looking at tariffs. The issue is non-tariff barriers and trying to estimate how much the administration thinks that U.S. business is being harmed by non-tariff barriers. The USTR actually identifies 14 different classes of non-tariff barriers. These run the gamut from anything from health and safety related regulations or labeling restrictions, that sort of thing. Some of them feel more economic in nature. Others are, maybe a bit less so, although the administration might feel differently about if certain health and safety regulations are actually for health and safety, or are they for to try and encourage, domestic production over foreign competition, right? But trying to find a way to get every non-tariff barrier reduced into just one number, that's a Herculean task. Just for one country, just for one non-tariff barrier. You think about when we went in the Section 301 tariffs against China, way back from 2018, that started the China trade war. The USTR took 7 months to write a report, several hundred-page report, just focusing on IP theft and the potential damage to the U.S. Industry. The number they came up with was a range of $225 billion to $600 billion annually in damages. So that's a $400 billion annual difference just from that one non-tariff barrier, just from that one country. The amount of work going into this in terms of trying to find that perfect number is just a Herculean task. And what we find ourselves coming back to over and over is it feels like the number that will come out of this will be a combination of the administration's views on the actual economic impact, but also their assessment, or Trump's assessment, of the level of damage and the level of negotiations or the level of pushback that he's been getting from other economies, for example. And so it just feels like there's a lot of room for uncertainty in terms of the level of tariffs that the administration will seek, because translating non-tariff barriers into a specific tariff level is already very difficult. It's already very complex. And it takes more time than the administration has given themselves. They want to move quickly. And I think that means that it's going to be very difficult to come up with a number just based on economic assumptions. And we should be continuing to make assumptions about Trump's opinion on how U.S. is being treated. We know he talks about digital services taxes in the EU, for example, as a potential source of uncertainty. Now, with all of this, there's two more things to consider. The first is sectoral tariffs, which are almost independent of what we're getting on reciprocal tariffs. So think about things like automobiles, for example, or pharmaceuticals or copper. That he's thinking about global tariffs independently or maybe even additive to a reciprocal tariff regime. So, for example, you could see a tariff increase of X% on all goods coming from Japan, but also an increase in autos in addition to that as part of sectoral tariffs. As we think about all of this, Trump's door always seems to be open for negotiation. There's always an opportunity for countries to try and negotiate their way into less extreme positions. And so we will be watching for signs of that. We already saw recently the EU actually delayed their reciprocal tariff increases, the retaliatory tariff increases, it looks like by a few weeks here. Maybe that's a sign that there could be some good news between now and April 2nd. And we're also watching for anything from the US that adds nuance to these policies. So, for example, are there exclusion processes? Will US businesses be able to petition the government for exclusions? Are there delays in implementation? Is the administration going to give time for businesses to adjust, or are they going to force businesses to adjust on the fly? Because we think about recession risk and we think about how markets are trying to price these hard landing risks that clearly have risen in the US. I think what markets are really going to be looking for is the speed of policy implementation and the ability for businesses and for consumers and for global economies to adjust. The more leeway that the administration gives and the more ability for countries to negotiate themselves to better outcomes, maybe the more the market is able to look at this, as maybe not as bad as feared. And of course, vice versa, that risk is there as well, that Trump moves, he favors speed over specificity, as he has done for a good chunk of his presidency so far. So there's so much uncertain on this. As we record this on the 20th of March, April 2nd feels like a lifetime away. It's going to be a lot of changes in how the administration signaling this, and probably on our own assessment as well. But that feels like a risk that is front and center for markets, and that's how we're thinking about it at the moment.
Brian, thank you so much for all that. It does feel like investors are really on tenterhooks, waiting for these numbers and waiting to see if there is room for negotiation as well. Guys, thank you so much for joining us for this week's podcast. If you did like the podcast, do remember to like and subscribe. Thanks again. Bye.